The stock market has fallen over the past 2 weeks, and now may be a great opportunity to buy the dip. We are seeing the largest tech companies in the world decline more than 15% from their recent highs. And the Nasdaq has seen a major pullback and is now negative on the year of 2021. And that index had a high of over 14,000 points, but has now seen a major pullback and sits down 10% at 12,700. And some major companies who are suffering through some drastic declines include Apple, who from their most recent high of over $142 is now down 16%. And the high-flying Tesla, where investors believed it could never go down, has dropped from a high of $880 plus down to $620, or close to 30%. And finally, the fintech giant in PayPal, who has been absolutely remarkable over the past few years, has dropped over 21%. And these are not the only companies that are going through some very big declines. Most of the big names on the Nasdaq are suffering some high double-digit drops over the past few weeks, and I believe this is a great buying opportunity to get in to some very strong companies over some short-term price fluctuations. And analysts are still very bullish on the tech sector, and we have projections of over 25% growth throughout this next year. And right now, this big sell-off is because investors are worried about rising interest rates and the rotation into value plays as the economy continues to reopen. But going forward, these Wall Street and bullish analysts believe that the digital transformation is still only in its earliest stage, and developments in 5G, cybersecurity, the cloud, and e-commerce will drive the tech sector to record highs going forward. And right now, we may be seeing some of the best buying opportunities since the March lows. Some of these high-flying companies that have accelerated over 50, 100, 200% over the past 12 months are all on major pullbacks to more fair and reasonable valuations. And for example, a company like Tesla has shedded more than $200 billion off their market cap during this most recent dip of close to 30%. So in this video, we're going to take a look at some high-flying growth companies that are on a major pullback as of late and may be trading at a very attractive level to start or add to an existing position. And before we do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button and subscribe to the channel. And now we're going to take a look at the first growth company, which is Qualcomm, ticker QCOM, currently trading for $127, and over the past month, the company has dropped around 19%. They have a current market cap of $155 billion and are now trading with a forward PE just below 18, which is very reasonable for a high-flying 5G semiconductor company. And taking a look, over the past 12 months, even with the major decline, they are now sitting above 68%, which is absolutely incredible. And they also pay out a nice dividend with a yield just below 2% at this current share price. And going forward, Qualcomm is expected to be a major player in the fast-growing 5G industry, which is still very early on in its growth and development. And I think 5G chips are going to be a long-term player in some of the leading phone brands all across the world. And taking a look, they just released a new chip, the Snapdragon 888, which will power flagship phones throughout 2021. And Qualcomm already has 14 different device makers who plan to use this chip over their next version of their newest phones, which is absolutely incredible. And Qualcomm has also just revealed a new line of wireless audio chips, and they're designed for connecting wireless speakers and headphones to Android devices and rival the ease of use that Apple has with their Apple headphone products. And I think this is a great advancement that Android devices really need to compete with Apple over the long term. And if we take a look, Qualcomm also pays out a 2% dividend, which makes up 35% of their net income, so it is safe and sustainable over the long term. And their 5-year dividend growth rate average is at 6.25%. And going forward, over the next 5 years, we're predicting close to 25% per year growth coming from this big chip maker. And taking a look, their current share price of $127 sits well below the 12-month expectation of $172. And they currently have a buy rating from Yahoo analysts. So overall, Qualcomm is definitely an interesting company to take a look at right now. They have declined over 22% from their most recent high, and now may be the time to buy the dip in this leading semiconductor name. And now if we move over to the next big tech company we're going to discuss today, we're going to take a look at Zoom Video. Ticker ZM, currently trading for $343, and over the past year, the company has grown by 190%, which is absolutely spectacular. But if we take a closer look, from that high point of $568 per share, the company now sits down close to 40% overall. They've dropped more than $225 per share, or 40% from the company's all-time high. And although we are expecting the economy to reopen very soon, I think Zoom Video and video communication is here forever. The pandemic has kickstarted us into that way of conducting business and living our lives, and I don't think that trend is ever fully going away, and I think Zoom has already made themselves the market leader in that fast-growing industry. And right now, the company's current market cap is at $108 billion, and they're trading with a forward PE still above 91, which is very high, but on the 52-week range, they are now trending slightly towards the lower end. And over their latest quarterly report, the company beat analyst expectations for both revenue and earnings per share. And the total numbers came in at $882 million of revenue and earnings of $1.22 per share. And going forward, the company actually raised their guidance for the full 2022 fiscal year and are now projecting around $3.65 earnings per share with revenue of $3.78 million, representing year-over-year growth of 42%. And I really do believe they can achieve these numbers, and I believe Cathie Wood and ARK Invest feel the same way. Because taking a look at the chart, as the yellow line, which indicates Zoom's share price has been crashing, the purple line showing the amount of shares owned by ARK Invest has been shooting up. So as Zoom continues to fall to record lows away from their high, ARK Invest has been buying more and more shares of this digital communication company. And we can see the company has purchased over 500,000 shares over the past few days. And taking a look, Zoom has a very strong balance sheet to sustain their operations going forward. Right now, they have total current assets of $4.8 billion compared to total current liabilities of $1.2. So a current ratio sitting well above 3, so very sustainable over the short term. And one thing that's a strong sign is that they have very little long-term debt on the business, and right now, their total liabilities are only at $1.4 billion, so they have a nice current balance sheet with a strong, healthy financial position that I think can lead them to very nice long-term success. And taking a look, even though the company's been on a downtrend as of late, analysts are still projecting 17% per year growth over the next 5 years in the future. And taking a look right now, the company's current level of $343 sits well below the 12-month expectation at $486 per share, and the company is considered a slight buy at this current level. So overall, a very interesting company in Zoom, the one name that was one of the top performers throughout 2020 that has seen a massive decline from their high point in late October about 5 months ago. And a drastic decline of over 40% in share price may mean that now is finally the time to pull the trigger and start a position in Zoom Video. And if we now transition to company number 3, another big player on the market that has seen a drastic decline as of late is Apple. The largest company in the world that is worth over $2 trillion has declined a total of 16% from their recent high of $143 per share. And if we see Apple continue to fall over the next week and that share price can drop below $110, I will be heavily buying more of this market leader. And although right now, Apple already sits as my largest position in this portfolio, I truly believe in this company long term, and I would have no problem buying more shares. And in the future, I believe Apple will be driven higher because of their services, which in the latest quarter generated over $15 billion in revenue, which was absolutely incredible. And some of those include Apple TV Plus, Apple Music, Apple Arcade, and many more. And right now in our world today, the companies who have subscription-based revenue models are growing at a terrific rate. And as an investor, I love to own the companies who have that predictable and consistent cash flow coming in every single month. And over the latest quarter, Apple's service revenue grew 24% year over year, which is absolutely incredible. And over the next few years, Apple is expected to expand their product mix, release new services, which will provide the company with very high profitability over the long term. And taking a look, by 2025, we're actually predicting that service profits alone will generate more than $50 billion for the company's total bottom line. And over the long term, I really believe that Apple services can be the leading revenue and net income provider to the company's entire business. And I believe that these high margin and high profitable services are going to generate the long-term success of the Apple name going forward. And if we take a look, the company does pay out a very slight dividend yielding 0.67%, but it only makes up around 19% of their total net income. They do grow that payment, averaging 10% per year, and this company has a very strong history of returning investors' capital through the form of a share buyback, which they spend tens of billions of dollars on every single year. And taking a look, over the next 5 years in the future, we're projecting over 14% per year growth, and Apple is currently considered a buy with a 2 rating. And the current share price of $120 is once again well below the 12-month expectation of $151. So overall, another big name company, the largest in the world, my largest personal holding that's on a 16% decline as of late, and maybe one of the best opportunities to buy in to the largest company in the world at a much better valuation than where we saw them trading only 2 weeks ago. And now if we move away from Apple, we're going to take a look at company number 4, which is the smallest cap name in this video, and that is Palantir. They currently trade for around $25 per share, and the company has a market cap of $44 billion. And taking a look at the 1-month chart, we can see that from a high point of $38, they've seen a very drastic decline of over 35%. And this is a young big data company, and right now, the demand for products to take large amounts of information and to actually turn it into usable information is growing at very fast rates. And Palantir is one of the leading brands to do just that. And taking a look, this is another company that ARK Invest has been heavily buying into as the share price has continued to decline. And over the past 2 weeks, ARK has purchased more than 4 million shares in a total investment of more than $100 million into Palantir at around $24 to $25 per share. And going forward, analysts have a ton of optimism surrounding the future growth and are projecting close to 50% per year growth for the next 5 years in the future. And taking a quick look at their balance sheet, Palantir has a current ratio well above 3, with $2.25 billion of total current assets and short-term debt coming in at only just above $600 million. And the company's done a great job of reducing their long-term debt over the past few years. Back in 2019, they had close to $400 million of long-term debt, now down to only $198, so they've reduced it by 50%, which is a great sign. And overall, around $1.2 billion of total debt on the balance sheet, which is not too bad compared to the $2.2 billion they have in total current assets at this point in time. So with a young company that still really is in the growth stage, it's very important to have a strong balance sheet just so that they can fund their operations in order to continue to grow and hopefully one day achieve true and full profitability. So Palantir is definitely another high growth company that's on a major decline as of late. ARK has been buying more shares. They must see some upside over the long term and definitely worth the time and the research into this big data name. And finally, we're going to move on into stock number 5 and the last big tech company that we're going to discuss today, and that is PayPal, ticker PYPL, currently trading for around $239. And over the past 12 months, the company is up 132% overall, and they have a current market cap at $315 billion. And from a high point of $304 per share, the company now sits down over 21%. And I think PayPal is a company that's going to be around over the long term. They're a well and trusted brand in the digital payment space, and I think that trust is going to stay with consumers as our society continues to trend to a more digital and e-commerce way of life. And I think going forward, PayPal has a ton of great products on the market that are still going to be used every single day. And over the next 5 years, the company's actually projecting to more than double their total revenue and their active users. And if we go over PayPal's income statement, year over year, the company continues to reach record highs. And in the trailing 12 months, they've generated $21.4 billion of total revenue. And taking a look at their bottom line, the company is very profitable as well, setting a record high net income of $4.2 billion. And we can see continuous exponential growth year over year. And with PayPal, a lot of their products come with very high margins, which is a great sign for this young tech company. And I think going forward, that profitability is only going to increase at greater scale. And as they plan to double their active users over the next few years, PayPal's business is going to be much larger and much wider across the globe than where it is today. And taking a look, over that next 5-year span, we're projecting 22% per year growth in the future. And I do believe PayPal can be a top performer in the fintech space. And as they continue to develop, get more into personal banking as well as payment solutions, I think this name can be around for long in the future and for decades to come. And right now, younger consumers are more trustworthy of these fintech brands like the PayPals and the Squares instead of the traditional banking system. So I think they have a ton of advantages as the younger generations turn into adulthood and the younger digital natives start needing more financial solutions. I think PayPal and Square, for example, are going to become the go-tos. And overall, these were 5 different stocks that have seen a major decline as of late in the market. We've seen the Dow fall negative on the year, and other major brands see massive declines. So I think now we're in a great buying opportunity. I love to buy the dip in the market. As you know, I consistently invest every single week in my portfolio, and I will be picking up some deals at these lower prices. And of course, the 5 companies that we went over today were not the only names that saw significant declines. So definitely keep your eyes open in the market for any good deals that may arise. And please let me know down in the comments on which companies that you're buying, if there's any stocks you want me to cover in a future video. And I want to thank you for watching to the end. I really appreciate it. And please hit that like button and subscribe if you haven't done so already. We post every single day, and I will see you in tomorrow's video.